Welcome to Talk Tickers. Today, we're digging into the Q4 earnings call for insurance broker Brown & Brown. And let me tell you, this report sent some seriously mixed signals to the market, and we're here to unpack exactly what happened. All right, so here's the game plan. We'll kick things off with those confusing headline numbers. Then we'll get into the real story, the two different kinds of growth happening inside the company. We'll also cover what management is promising for the future, why the stock took a nosedive despite some good news, and we'll wrap it all up with our take on what you should be watching for next. So on January 27th, Brown & Brown drops their Q4 report, and right away, it was a real head-scratcher for investors. It was one of those classic situations where the top line and the bottom line were telling two totally different and, frankly, conflicting stories. At first glance, you might think, hey, not bad. The company posted adjusted earnings per share of 93 cents. That beat Wall Street's expectations by 2 cents. And in any normal quarter, that's a check in the win column. But, and this is a big but, this was not a normal quarter. While the earnings look good, the revenue, the top line, told a much weaker story. Total revenue came in at $1.6 billion, missing the consensus estimate by about $50 million. Now, that's not just a little miss, that's a pretty significant gap that the market just can't ignore. And boom, this right here tells you everything you need to know about how the market felt. Before the opening bell even rang, the stock plunged over 8%. That wasn't just a little dip, folks. That was a loud and clear signal of some deep investor concern. It tells us that the big revenue miss far outweighed that small earnings beat. Okay, so to really understand what's going on here, you have to peel back the onion a little bit. To get why the market had such a strong reaction, we've got to look past the headlines and see how Brown & Brown is actually growing. Or, in this case, not growing. So on one side of the coin, you've got this huge reported growth number, almost 36%. But that's all fueled by an aggressive shopping spree. They made 43 acquisitions this year alone. But then, on the other side of the coin, if you strip out all that buying activity and just look at the core underlying business, well, it actually shrank by 2.8%. And that is a major, major red flag for investors. Now, this is where it gets really interesting because we can pinpoint exactly where the problem is. So where did that weakness come from? Well, the retail segment actually did okay. It eked out a small gain. But look at that specialty distribution segment. It didn't just dip, it completely fell off a cliff, dropping a whopping 7.8% and dragging the whole organic picture down with it. So what did management have to say about all this? Well, they got on the call and tried to paint a positive long-term picture, but they also had to deal with a pretty big and very immediate problem that was clearly on everyone's mind. So management's play was, hey, look over here, look at the future. And to be fair, they laid out some good points. They bumped up their long-term profit targets, they pointed to a hefty $30 to $40 million in savings they expect from a big acquisition, and they guided for a little improvement in their retail segment next year. All good stuff, right? Well, that positive view was completely overshadowed by this. The CEO came out swinging, describing what he called a highly coordinated plan by a startup competitor to basically steal entire teams and take their clients and information with them. Yikes. And they didn't just talk in generalities. Oh no, they put a number on it, a big one. They said the departure of 275 of their people has already cost them a known $23 million in annual revenue. This wasn't some vague threat on the horizon. This was a real, tangible hit that grabbed the market's full attention. Okay, let's connect the dots here. You've got management talking about their great long-term plan, and you've got this immediate, brutal reaction from the market. So why the disconnect? What gives? It really all boils down to the market's obsession with one single metric, organic growth. Think of it like a restaurant. You can grow your business by building new restaurants all over town. That's like an acquisition. Or you can grow by getting more and more people to come to your one original restaurant. That's organic growth. And Wall Street cares a whole lot more about the second one because it proves the health of your core concept. And that's exactly why investors treated organic growth as the truth serum for Brown & Brown. That negative 2.8% number, plus the bombshell news that a competitor was actively poaching their talent and clients, well, that spoke a lot louder than any promises about the future. The market just saw a core business that was shrinking and under attack, and it reacted accordingly. All right, let's bring it all home. What does this all mean for the next quarter? And what should you, as an investor, be watching for? Looking ahead, it really comes down to three key questions. Number one, can they stop the bleeding in organic growth, especially in that disastrous specialty distribution segment? Number two, are they actually going to deliver on those promised savings from their acquisitions? And number three, and this might be the most important, is that $23 million loss from poached clients going to get even bigger? So putting it all together, here's our call. We think these problems are going to stick around for a little while. Those client losses and the tough market dynamics will probably keep that organic growth number under pressure. For that reason, we're initiating our coverage with a market perform rating. Basically, that means we expect the stock to perform in line with the broader market, probably trading sideways until we see some real proof that the core business is back on solid ground.
This is not financial advice.